Welcome to today's lesson. Today we are going to look at a topic called marginal and absorption costing. There are several aspects that you need to understand. So I'm really hoping that you can be able to get the most from today's lesson. So we'll just use a question so that you can be able to calculate profit using marginal and absorption costing. So sometimes you can be told to calculate profit using either marginal or absorption costing method. So we're going to start with the format. So marginal and absorption costing, they have formulas that you have to follow for you to be able to work out this question. So we are going to look at the format for marginal costing and the format for absorption costing. It is good that if you are noting down, you note it down. Then we are going to go direct to the question after we look at the formats. So let us start with the format for marginal costing. So the format, it is as simple as you can see. For example, we are calling our company XYZ Limited. We have operating statement, marginal costing, and of course the date if you've been given the date. So the title for marginal costing is the same as the title for financial accounting. So you just write XYZ Limited, operating statement. Here we are using marginal costing, and it is also good that you indicate the date. From there, you're going to write the sales. So this is just the format. By now you're supposed to know the variable costs. Which ones are the variable costs? So we are going to subtract variable costs, and we are going to start with the opening stock if it is given. If it is given, you write the opening stock. Then direct materials, direct labor, variable production overheads. Of course, when you talk about direct variable costs, we say these are costs that will change with changes in production. For example, for materials, the more you produce, the more materials you'll need. Labor, the more production, the higher the labor costs. So also we have variable production. OH stands for overheads. So if you see anywhere I've written OH or OHS, this stands for overheads. So here we're just going to indicate opening stock, direct materials, direct labor, and variable production overheads. So after we get the total, we are going to less the closing inventory. Closing inventory is the same as the closing stock. Inventory, another name of inventory is stock. So it is similar to closing stock. So here we are going to subtract, and then here we are going to indicate the total. After adding and subtracting, then you're going to get contribution. So contribution we get after taking the sales less variable costs, and we are indicating that we have opening stock that you are going to add to direct materials, direct labor, and variable production overheads, and you're going to subtract the closing stock for us to be able to get contribution. After getting contribution, we'll proceed with subtracting the other variable costs, all the other variable costs that will be given. So you can be given variable selling and distribution expenses, or variable selling and distribution expenses, and you can also be given variable administrative expenses. So you're going to subtract all the other variable costs for you to get the total, and here after subtracting we will have what is called total contribution. And after getting total contribution, and I would also like you to go to break-even point, where we were saying after getting contribution you subtract what is called fixed cost for you to be able to get net profit. So all the other fixed costs, the good thing is that you'll be given maybe the name, fixed production overheads, fixed administration overheads or costs, fixed selling and distribution overheads. Anything that is fixed is going to be subtracted from contribution for you to be able to get the net profit. By now you're supposed to know contribution minus fixed costs is going to give you profit. By now you're also supposed to know sales minus variable costs will give you contribution. Those formulas are very important, especially in the course of management accounting, because it seems that a good percentage of the topics you are supposed to get contribution and you're also supposed to get profit. So by now, sales minus variable cost will give you contribution, and contribution minus the fixed cost will give you what you're calling net profit. And that is how you're supposed to calculate the net profit using marginal costing method. Unless there is a question about the format, but this one is very direct. So I've really emphasized on sales minus variable cost will give you contribution, and contribution minus fixed cost will give you what you're calling net profit. So I want us to look at absorption costing. Yes, Omar, you have a question? Divin. Yes? Mm-hmm. 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 Oh. Okay, thank you for that. So for the here we're just saying that this is the format for marginal cost. It's just a format, but the concept is the same as you're saying, where you take the sales, you less the variable cost. But for the sake of the format of marginal cost, that is why we are only including the variable production overheads only here, and then after that, that's when we are considering the other variable costs. It's more the same because at the end of it all, we are going to get total contribution. But then you're going to look at other sums and see how we go about that. But thank you for that. So let's proceed to what we are calling the format for absorption costing, getting net profit using absorption costing. So the format is a little bit different, but not very different. Though sometimes you see you can be given some other items and sometimes you're not given some other items. So here for absorption costing, we use sales. Then you're going to subtract what we are calling cost of sales. Sales, then you're going to subtract cost of sales. Of course, when you take sales and you subtract cost of sales, what do we get from financial accounting knowledge? Gross profit. Yes, that is true. So from financial accounting knowledge, sales minus cost of sales will give you what you are calling gross profit. So from there, under cost of sales, we are going to use opening stock, direct materials, direct labor, and then we're going to use variable production overheads and then fixed production overheads. Kindly, I hope you're getting the difference between absorption costing and marginal costing. So for marginal costing, we were using sales minus variable costs. And then we were taking opening stock, direct materials, direct labor, and then the last thing was variable production overheads, so that we can go to closing stock. We less closing stock. But now here it's a bit different because we are using opening stock, direct materials, direct labor, variable production overhead specifically, and then fixed production overhead specifically. So you'll find that there are other variable costs, there are other fixed costs, but we are specifying that we are only going to use variable production overheads and fixed production overheads. Then after that, we are going to subtract now our closing inventory. Yes, I can see there is a question. Any question? Yes? Okay. So, what is overheads? Nilikuwa nasema overheads, or what is another name of overheads? Yes, ama costs. Overheads. So nikisema overheads, I think another name is variable costs. Yeah, actually I've seen an overhead cost or expense. Overheads kama lighting, indirect costs. If we introduce indirect, does it mean direct costs cannot be overheads? Okay. So let us just say okay, the good thing is that we have Google. So overhead expenses are all costs on the income statement except direct labor, direct materials, and direct expenses. So is it the reason why you're saying overheads ni indirect? Mark. Okay. So another name of overheads ni costs ama expenses. So we can proceed. So I hope I've answered that, ama we have answered that. And I think we need to, okay, welcome. Let's move fast because of time. So we're going to subtract closing inventory. Then after that, we are supposed to get what is called gross profit. But there is the aspect of under and over absorption, of which we're going to discuss in our next lesson. In other words, we are just taking sales minus cost of sales. Of course, cost of sales will have opening stock and closing stock from your financial accounting knowledge for us to be able to get gross profit. After getting gross profit, we are going to have what is called non-production costs. So anything that is not considered as a production cost is considered as a non-production cost. And here we are going to accumulate all costs, meaning variable and fixed. Tunaona hapa tumemix. We have just taken gross profit, then tuka subtract variable selling and distribution, fixed selling, variable admin, and fixed admin. And then we have what is called net profit. So I think if we can do a question, it will be more reasonable. Okay. So here we just get gross profit. Gross profit after taking sales minus cost of sales. And then you also subtract non-production costs. Acha tutafika hapo. So let's proceed to a question so that you can be able to relate what you have learned. So XYZ Limited has provided the following details for the month of April 2015 in respect of production and sales. So we have a company here that has all this. So the sales, and here note, sales in form of units is 10,000, production 12,000. Then you have selling price. This is cost data per unit of output. So note we have selling price, then direct material cost, this is per unit, labor per unit. Per unit of course inamaanisha the costs of producing one product. So we need 360 shillings for us to be able to produce one product in terms of material cost. And then we also need 80 shillings. So ni kumaanisha we are going to use 80 shillings in form of labor for 1 unit, tukiproduce 1 unit of this product. Then we proceed. We also have variable production overheads ni 60. Alafu we have other costs, and here I can see ni fixed costs, fixed production overheads, this amount, and note hapa ni in shillings but not per unit, ni yote. Then we have fixed selling expenses, fixed administrative expenses. Of course for fixed costs tulisema rent is a form of fixed cost, and we cannot say that or we cannot say we are going to pay rent per unit of production. So for fixed costs, if we produce 10,000 products, the rent will still remain. So we have some additional information. We have what is called variable selling costs, ni 10% of sales. Variable selling costs, 10% of sales. Normal production capacity is 11,000 units. You're required to prepare an income statement for the month ending 30th April 2015 using marginal costing and using absorption costing. So when you're given such kind of a question, of course you'll start with the title, and here we have our title as XYZ Limited. So we are going to start with marginal costing. So XYZ Limited, and you're supposed to prepare an income statement for the month of April 2015 using marginal costing method. So it's not a must you put all these lines, but it will help you with arranging your work. So of course we are going to start with the sales. If the sales is 10,000 and that is 10,000 units, so tukiuza we are selling 10,000 units, alafu the price per unit, price ya 1 unit ni 1,000. So what will be the sales in form of money now? What are we going to do? $10 million. 10 million, 10 shillings. So ninasema tuko na kampuni tunauza nini sasa? Tutauza nini leo? Tunauza viatu. So sales zetu ni 10,000. Hizo ndio viatu tumeuza. Alafu that is shoes, 10,000 shoes. Hivyo ndo namaanisha. Na kiatu moja ni 1,000 shillings. Sasa ninauliza sales zetu zitakuwa pesa ngapi? Tutasema tumeuza viatu ngapi? in form of money. 10 million, yes. That's why we are saying we are going to take our sales in form of units times the selling price. Selling price ni for each unit, so 10,000 times 1,000, so kumaanisha sales itakuwa 10 million. So because of zeros, that's why we normally put zeros hapo juu. So then we less the variable costs. For variable costs, we are going to start with opening stock. So hapa hatujapewa opening stock, hatujaambiwa opening stock ni ngapi, but we have been given the closing stock. What do you think? For example, you are told sisi tumeproduce 12,000 shoes. Nitumie viatu leo. So we are manufacturing shoes, a company that manufactures shoes. So sisi production yetu ni 12,000 shoes. But sasa venye tulienda tukauza, sisi tuliweza kuuza, we were able to sell 10,000 shoes. So we produced 12,000, but sasa in that month we only managed to sell 10,000. So alafu mtu akuja kuulize, what is the closing stock for that month? Ama what are we remaining with? So what do you think should be the answer? 2,000 shoes. Yes. So these 2,000 shoes, this is what you are calling the closing stock for that month. So at the end of that month, tutasema tumebaki na 2,000 shoes. Of course, shoes ndio stock yetu. So that means that 2,000 will be our closing stock. So if that is the case, hesabu sasa inakuwa rahisi. So we already we have saying hatuna opening stock because hizo ni zenye tuliproduce. So something else, this closing stock will be the opening stock for the next month. For example, hii mwezi we are preparing the income statement for this month. So, and here in this question you are considering that the month is April. So closing stock ya April ni 2,000, tumebaki na 2,000 shoes. Unaona, these 2,000 shoes will be our opening stock. For example, kama tungeambiwa we prepare the income statement for the month of April, May. So these 2,000 shoes ambazo ni closing stock za the month of April ndo zingekuwa the opening stock for the month of May. So that is what we are saying in form of opening stock. So hapa hatujapewa opening stock kwa sababu hakuna stock tumeambiwa ilibaki the previous month, so that we now call it the opening stock in the month of April. That's why we are writing a dash. So let's proceed. Materials. Sasa hapa so here the direct material costs for 1 unit ni 360. Yani for us to be able to produce 1 unit, tunatumia direct material costs per unit ya 360. Tuseme ni viatu. So what we are saying, 360 ndo material itatumika kutengeneza kiatu moja. The cost per unit, the cost of one shoe. Sasa alafu we are able to produce 12,000 shoes. Alafu mtu akuja kuulize what is the material cost for all the units, for producing all the units. What are we going to do? Are we together ama nimewapoteza? Yes. So we're just going to say material cost for one unit is 360 times production at 12,000, so that you can be able to know the material cost in form of shillings for all the units, which is 12,000 units. So the same thing applies for labor and also for production overheads. We're going to say 360 times 12,000, 80 times 12,000, and 60 times 12,000. This is it. For us now to be able to get the total cost, so 360 times 12,000, you get that, 80 times 12,000, and 60 times 12,000. So the total cost is 6,000. Then you're going to subtract what you are calling the closing stock, and you have said closing stock will be 2,000 times 500. So 500 for marginal costs, 500 we are going to add 360 plus 80 plus 60. Hope it will give us 500. Yes. So for closing stock using marginal costing, utachukua 360 plus 80 plus 60, itakupatia 500. That's why you have this here. So 2,000 times 500, you get that. Get contribution, and then you're going to subtract the variable cost, the other variable costs. So, and here we were given variable selling cost as 10% of sales. So kumaanisha ndachukua 10,000, 10% times 10,000 for us to get 1,000. So the total contribution now will be 5,000 minus the variable costs, variable selling costs, for us to be able to get the total contribution as 4,000. Then from there it's easier because you're going to subtract all the other fixed costs. And for fixed costs we have 1980, 300 and 500, and that is how you calculate profit. Sikuandika hapo profit, I could have written. That is how you get what is called profit using marginal costing method. So let's use absorption costing. Oh, is there any question? We were just using the formula. Okay. Okay. So let's proceed to absorption costing. For absorption costing, we start with the sales. The concept is the same. Sales itabaki 10 million less variable costs. These ones will still remain. Materials. So here I said we call it cost of sales, but pia ukitumia variable cost sio, but variable cost hapana, because of the fixed production overheads. So hapa let us just stick to cost of sales, because tukisema variable cost and you have subtracted fixed production overheads, we have added, it makes sense. So let us stick to our cost of sales here. So of course kungekuwa na opening stock, but we do not have, so we go to materials. So we still use the same hapa. Unaona hapa material yenye tulitumia 4320 na hii labor 960 na hii variable production overheads. The only difference ni ati in absorption costing we are going to add what is called fixed production overheads, of which in the question the fixed production overheads is 1980. Ndio hii fixed production overheads. So in short, what am I saying? Sales less cost of sales. Avoid this term variable cost, because it's going to mix everything up. So naweza kuwa niliandika na haraka. So here we are writing cost of sales, and we are saying we are taking materials, labor, variable production overheads and fixed production overheads. After we add that, we are going to subtract closing stock. So the closing stock for the month of April remains to be 2000 times 680. It is good that you know the difference between the cost per unit in terms of closing stock. Ujua hapa tumetumia 680, but for absorption costing it is 500. So 500 for marginal costing, 680 for absorption costing. That is a very major big difference that you're supposed to know. So the reason why, yes, there is a question. Okay, nilikuwa nakuja hapo. So the reason why we are using 680, you see this closing stock that we are using the cost per unit ya materials, labor, variable production overheads and fixed production overheads. So let me show you something. Unaona hapa kwa here where you have the marginal costing, the reason why we have 500, this 500, is because we use the material cost per unit of 360, the labor cost ya 80 na variable production overheads ya 60. So tukasema 360 plus 80 plus 60. That is the cost per unit. When we added, that's when we have 500. That is for marginal costing. But when we come to absorption costing, it's a bit different. Reason, we are using materials, labor, variable production overheads, alafu we are using what we are calling fixed production overheads. So we are supposed to get the fixed production overheads per unit, the allocation of fixed production costs ama overheads for one unit, so that you can be able to get now the 680. So the total cost ya fixed production overheads ni 1980,000, ama unaweza sema 1.98 million. So what you do, the normal production capacity is 11,000 units. So for us to be able to get the fixed production overheads for one unit, what you do, and don't forget, utachukua this 1980,000 divide by the normal production capacity. And it's good that you note it down. So for you to be able to get the fixed production overhead per unit, so utachukua hii 1980,000 divide by the normal production capacity. What are you getting? $180. Very correct. So you see that 180 is what you're going to add to 500. So 180 plus 500, you're supposed to get 680. So 1980,000 divided by the normal capacity, yes, you get that. So from there, now we get gross profit. So gross profit, you're going to get sales minus the cost of sales so you'll be able to get gross profit. So from there, we said after getting gross profit, we are going to subtract what we are calling non, hapa sijaandika ka heading, but it should be non-production costs. Non-production costs, so any other cost. Now una mix both variable and fixed costs for you to be able to get net profit. So you have selling expenses, fixed and variable, and you also have admin. So of course hizo tumepewa hapa. So fixed production overheads tulitumia fixed selling expenses 300,000, fixed administrative expenses 500,000. Una cost ingine kweli? So 300 and 500. We also have the variable selling cost, by the way. This one, variable selling cost. So for absorption costing, tunaiweka pale under non-production costs. So kuna hiyo 300, 1000 and 500, subtract and you get net profit. Sijui kama kuna swali. Okay, if there is no question, tunaweza angalia another deeper question. Hii unajua ni warm up. So unajua tutaweza kumaliza, but I'll share with you the document with the workings, but I must put something across so that niwaache mkiangalia hii hesabu. So RH makes and sells one product which has the following standard production costs. So here we have been given direct labor 3 hours at 6 shillings per hour, so hapo ni 18. Direct materials 4 hours at 7 shillings per hour. Then you have variable production overheads, then you have fixed production overheads, alafu tuko na the standard production cost per unit. Then tumeambiwa we have what we are calling normal output per annum. Remember the other question, hii tulikuwa tunaita normal capacity, and we use this to get the fixed production overheads per unit. The good thing ni ati hapa tumepewa per unit, so here it's a bit different. Tumepewa per unit, hatujapewa for all the units, so here we are safer. So we have variable selling, distribution and administrative costs. We are told that they are 20% of sales value. So 20% of sales will give you the variable selling, distribution and administrative costs. For fixed selling, distribution and administrative costs, it is 180,000 per annum. Alafu, there are no units in finished goods inventory at 1st October 2002. So hakuna units zilibaki. That is, ukiambiwa there are no units as at 1st October 2002, that is the previous year ama the previous accounting period, ni kumaanisha, and here we are preparing for March, so hakuna opening stock. So the fixed overheads expenditure is spread evenly throughout the year. The selling price per unit is 140. Then tumepewa production and sales budgets are as follows. So hapa tumepewa 6 months ending 31st March 2003 and 6 months ending 30th September 2003. Tumepewa production 8500, sales 7000, production 1700, sales 8000. Then you're supposed to prepare a profit statement for each of the 6 months periods using the following method of costing: marginal costing, of course, and absorption costing. So here, this question is a bit funny. Here you're supposed to prepare a 6 months income statement ama profit statement. So kuna hii ya March na kuna hii ya September that we are supposed to prepare. So it is not difficult. You still use the same format. So the name of the company is RH, and then profit statement, and here we are using marginal costing, and then the date. Then we start with sales. So here we are supposed to prepare profit statement. So tunaanza na profit statement ya March, then you are going to prepare the profit statement for September. So ya March, hii ni rahisi. the concept is the same. We start with sales. Our sales is 7,000 times the selling price. So hapa ni sales in units. So si unachukua tu 7,000 times the selling price. Selling price per unit is 140 for us to be able to get the sales. Ndo hii 980,000. So 7,000 times 140. Then you're going to subtract the variable cost. So there is no stock that remained in the previous year. So hapa we do not have the opening stock. We take the direct labor. So labor here we are taking production 8,500 times 18. Then 8,500 times 28 and 8,500 times 3 for marginal costing. Then you're going to subtract the closing stock. So why are we using 1,500 as our closing stock? Yes, Roslyn? Yeah. Yeah, exactly. So that's why we're using 1,500. So we produced 8,500 but we sold 7,000. So 1,500 is the closing stock. And this closing stock becomes the opening stock for the other period. But so I think what we should do, because of time, I was thinking of leaving it. I leave it, you work it out. But because I've already calculated it, why can't you, I just send you this document, you go through it. Then in our next lesson, you can be able to discuss it. And we can also be able to conclude marginal and absorption costing. What do you think? Okay. So let me send you the document immediately, because I can see time is, we will not be able to finish all this. But that is the concept, and I'm also going to see if I can get some extra questions, practice questions for absorption and marginal costing. But once you understand the format and how to apply the format, you're good to go. So in our next lesson, you're going to start with this question so that we can move on well. So with those few remarks, I wish you all the best. Let's meet in our next lesson. Thank you so much for your time. Thank you. Thank you. Good night. Thank you.